I'm seeing a massive investor doing something, and I'll show you what I mean. Look at the top two flows. It's IVV and VU, which you guys all love and know is the S&P 500 ETFs, typically used by advisors. Look at the amount of money. Now, normally I'd think this was tax-related or operational, but rebalancing should have happened in December. So this is likely, my theory is, I call Merrill Bigfoot because they're a model portfolio of about $100 billion. And they own more than that of each. My guess is they've allocated more to the S&P. I could be wrong, but clearly it's a big fish doing something here. The rest is a little more sentiment read. You're looking at a little hesitation. You got bonds in here and gold, but largely people buying into the market, nothing too bearish in there. Let's look at the outflows. The outflows, look, there was a knee-jerk reaction earlier, and you see some outflows from some of the trading crowd favorites like SPY, XLF, IWM, but largely you can see money coming back in over the last couple days. And let's look at the past 24 months of ETF flows, because I want to talk about this trading crowd and the retail crowd together. ETF has taken in $2.4 billion a day for the past 3 months. If you added up January, December, and November, you would get a record quarter if that were an official quarter. Now, normally ETFs take in $1.2 billion a day, so they're taking in double the normal. Scarlet, because the trading crowd is excited. So as long as they're excited, you're going to see double the flows. Something spooks them, they're going to pull back, and we'll go back to about $1 billion a day.
All right, new year, new trading environment. Let's bring in Sylvia Jablonski. She is Managing Director of Capital Markets at Direxion, and Claire Ballentine, a cross-asset reporter for Bloomberg News. Sylvia, let me start with you, because if anybody knows the trading crowd, it is you guys at Direxion. Based on what you see and what you've heard from your clients, what does the trading crowd make of the fact that U.S. stock indexes are no longer moving just 0.2% on a daily basis?
So the trading crowd is very excited about it. If you look at the flows in various 3 beta ETFs, which we're sort of known for, you've seen upwards from 100 to 200% change in daily volume, 20-day daily volume. So particularly of interest are the China funds. All the China and the bull and bear funds have just been whipping around 100%, 200%, which is actually great to see, because that means that investors, last week when we got the news of the coronavirus and we really saw the pullback in that particular region, we saw people flocking to the bear funds. And then when we saw sort of the reversal on Monday and Tuesday, we saw it go back into the bull funds. So I think that traders who looked at that, short-term opportunity gathered some alpha in their portfolios and then sort of moved on when the market started to recover. Other interesting trades along the same theme, tech went back up in terms of volume. Eric, I saw you tweet something about, tech L 10,000% since inception. So
it's ridiculous.
It's
10,000% since inception. It's 13 times.
Back.
It's compounding effect. It's weird math that works in your favor occasionally.
It does. Low volatile trending market. That's when it works really well.
Yeah, and just talk yin and yang. We looked at, you have a bunch, by the way, you've just exploded with all these China ETFs. Yin and yang are the famous ones, but you have these other ones, and they're all seeing major volume increases. Is this just, look, if there's a volatility somewhere, you're going to see your crowd come in and start to play this, right? And so describe what's being played here by these 5 ETFs.
Sure. So for Yin, Chow, and CWEB. So Yin is the China H shares. So they're basically the Chinese stocks that trade in Hong Kong, and Chow is the A shares. CWEB is basically China Internet. So what happens there is that last year, if you look at those products, Yin, for example, was up over 20%. CWEB was up double digits. And what happened there was it was a good story. We had a phase 1 trade deal. We had a lot of good news about, the largest growing middle class population, the second biggest contributor to the, world economy. And what happened since is essentially the coronavirus. A lot of the local businesses are shut down. It impacts A shares more than let's say H shares. And investors went in, looked for those opportunities around the up and down volatility and pullbacks of the market.
All right, of course, coronavirus is top of everyone's minds, Claire. It threw everyone for a loop, and for a while it seemed like investors couldn't really make up their mind as to whether to be risk on or risk off. What are you seeing?
Yeah, we're really seeing news of the coronavirus really impacting ETF flows. So first we saw big inflows into ultra short income ETFs, for instance, JPST, as investors were searching for less volatility. Then a few days later, we're sort of looking at funds tracking the S&P 500, some seeing big inflows, some seeing a big outflow. So it really highlights how investors aren't quite sure what's happening.
Absolutely. And of course, another big story this week is the explosion in Tesla shares. We're really not quite sure what the catalyst is. Maybe it's short covering, but apparently a lot of people, including Steve Eisman, have already covered their shorts.
Look, everybody has a pain threshold, and when a stock becomes unmoored from valuation because it has certain dynamic growth aspects to it and has cult-like aspects to it, you have to just walk away.
Steve Eisman, of course, known for shorting CDOs before the financial crisis.
Yeah, and speaking, Tesla's return is like a freak of nature, in a good way for some ETFs. Which ones are seeing the most pop here, Claire, from this?
Yeah, so unsurprisingly, a couple of auto ETFs are really benefiting. So a ticker CARZ is really benefiting. A couple of clean energy funds.
Makes sense.
One of the biggest ones is the ARK Next Generation Index Fund that has about a 12% stake in Tesla. And about half of its gain this year can be attributed just to owning Tesla.
Yeah, Sylvia, you need to come up with a triple leveraged Cathie Wood ETF. I think there's a market in that. Speaking of which of the leveraged ETFs you do have are getting a little Tesla pop?
Yeah, so I actually think that it's sort of thematic. So it's playing whether or not it necessarily holds the ETF within the index. What we're seeing is a pop in UBOT, which is AI and robotics, and also technology. So I think that people sort of equate Tesla to technology, artificial intelligence, and robotics. And we've seen some short-term pops in that ETF. And also, again, going back to coronavirus, what happened in the market? They were on sale. On Monday, they were on sale. They're, Apple's back up. A lot of those names just really popped those indices.
Sylvia, before we go, I got to ask you really quickly. ESG is all the fad here in 2020. I shouldn't say fad because it may very well be a sea change here. You guys have come out with some leverage funds on ESG as well. Explain very quickly how it's different from what's available.
Sure. So these are a little bit different in sort of a few ways. So our ticker is ESNG, and what we do is we have a 150-50 structure, which allows you to have enhanced exposure to companies in the MSCI USA Leaders Over Laggards Index that have positive ESG characteristics and are also trending upward towards those things. So it's momentum and positive ESG scores. They're rated like bonds, AAA all the way to CCC. The top names are in the top. So the bottom basket is essentially the companies who aren't doing so well in that space. So sort of the less positive corporate governance, social governance, gender equality, things like that. So they're shorted on the leg of the 50. So it's 150-50, it's 100% exposure. So it's not leverage in the same way. It's meant to be long-term buy and held, but it allows you to get a real enhanced exposure to the ESG factor. So it's a little bit different than the others because you're actually shorting the companies that you don't think are the top ESG names.